Yesterday, the FOMC announces they're going to start tapering their balance sheet by $95 billion a month and hiking interest rates. A quick review of history about what interest rates do during those periods coming up on 3 Minutes on Markets and Money. The recent FOMC minutes show that the majority of the FOMC members support tapering their balance sheet at a bit faster rate than what markets had previously expected. This kind of led to a bit of a sell-off yesterday and a pickup in interest rates. However, looking back at history, we have to review what happened the last time the Fed was tapering their balance sheet, hiking interest rates, and what happened to the financial markets during that period of time. So going back and looking at specifically the 10-year Treasury rate as a proxy for interest rates in general. In 2018, of course, this was when the Federal Reserve was really just starting to talk about hiking interest rates. They'd been on a rate hiking campaign from 2017 into early 2018. Hiking interest rates, talking about the idea that they're nowhere near the neutral rate. They need to raise interest rates more. Of course, as they began to actually taper their balance sheet in 2018 and the balance sheet was beginning to roll off, that was where the markets really began to get into trouble. We got into the 20% decline that we saw in the markets, in late 2018. This is where the Fed stopped tapering the balance sheet. This is where the Fed stopped hiking interest rates, talking about, they're actually closer to the neutral rate than they thought. As we got into 2019, markets were doing better at this point. Stocks were going up because of the fact that the Fed was backing off. And in mid-2019, the Federal Reserve started dropping interest rates back to zero. They began bailing out hedge funds through reverse repo. And during that period of time, interest rates in the 10-year Treasury continued to decline. Of course, this is exactly where we got into the pandemic at this point, and interest rates dropped down to 0.5% as the Fed was in full bailout mode. This is the important part of this cycle. As the Fed is raising interest rates initially, interest rates in the 10-year Treasury tend to rise. Once they begin to start causing a problem and began tapering their balance sheet, interest rates begin to move into risk-off mode. In other words, money's moving out of stocks and equities into bonds for safety. This causes interest rates to fall, even despite the fact that the Fed is no longer the buyer of bonds. This is one of the misconceptions by the mainstream media right now. It's like, oh my gosh, interest rates have to keep going up because there's no artificial buyer of the Fed. That's not really the case here, because once the markets figure out that this rise in interest rates, along with the Fed hiking rates and tapering their balance sheet, is tightening monetary policy too quickly, which also ultimately leads to a recession in the economy and a decline in the stock market, interest rates begin to drop rather sharply because of the fact we're now moving out of equities risk on into bonds, which are risk off. And this is why most likely by the time that we get back down into the next recession, interest rates are going to ultimately retrace back down to this 0.5% level, maybe even closer to zero this time around, as the Fed's trying to balance this act between fighting inflation and trying to support the economy in a recession. That's 3 Minutes on Markets and Money. We'll see you next time. Quick review of history about what interest rates do during those periods coming up on 3 Minutes on Markets and Money. Coming up on 3 days of Markets and Money. It's going to be a really long show.